Hello, in this video we'll discuss federal wealth transfer taxes. Now all the taxes that we've been dealing with up to this point have been income taxes. This video will focus on wealth transfer taxes, which have a different system. Now within the wealth transfer tax system, there's really two types of wealth transfer taxes at the federal level. There's an estate tax and a gift tax. Now the estate tax imposes the tax on the decedent, the person that dies, their entire estate. And the tax is on the right to pass property at death. A gift tax is a tax on inter vivos, which means lifetime transfers for less than full and adequate consideration. So basically by full and adequate consideration, for less than full and adequate consideration, we're talking about anything other than a sale. And it's payable by the donor, so the donor pays the gift tax, not the donee. Now it's important to understand that inter vivos, again, which is lifetime, there's also testamentary, which means death, on death. So there's a formula for the federal gift tax and there's a formula for the federal estate tax. This is the formula for the federal gift tax, and as you notice, there's a few things that you should focus on here. The first is that every year an individual donor gets a certain annual exclusion amount, and it changes each year. That's why I don't have the number set. It changes, well, not every year, but it changes some years. Some years it's the same as others, but usually goes up through inflation. So you have to look at that specific amount, and it's per donee. So a donor is given a certain amount. Let's say it's $10,000 for a specific year. That's what's allowed under the law, and it's not going to be $10,000. It's going to be more than that. But if it's $10,000, it's $10,000 per donee. So technically, a donor could give a lot more than $10,000, because if they give to a lot of different donees, then you get to use that exclusion amount, that annual exclusion amount per year per donee. So if you have 10 different donees, and it's $10,000 that year, that's 10 donees times $10,000, that's going to be $100,000. Another thing to notice is down here at the bottom, we have the gift tax paid on past taxable gifts and the unified credit. So you're going to see this unified credit, which basically unified in the sense of gift tax and estate tax. Everyone gets a lifetime unified credit that they can use for federal gift and federal estate tax purposes. It's unified in the sense it's a unified system. But we'll talk about that in a little bit more, but keep that in mind. So we start, and one thing to note is that with income taxes, the tax is based off income. With wealth transfer taxes, it's based on fair market value. Very important difference. Fair market value is what we use. Now there's some things that get deducted out, some deductions, charitable and marital deductions, and we look at some other things, but those are really the big items. So the federal gift tax again applies during life inter vivos. The estate tax is determined at the end upon death. And we start with the gross estate, which we're going to talk about that generally. We subtract out various deductions. There's a lot more deductions with the estate tax than there is with the gift tax. Now in the gross estate, again, we're using wealth transfer, so we're using value, fair market value upon death. That gives us a taxable estate. We add in any taxable gifts, we get our tax base. And the reason we add in taxable gifts is because we're going to use the unified system again, the unified tax credit for both gift and estate tax. Then we have our tentative tax. We subtract out any tax credits and the unified amount, the unified credit amount, which applies to both gifts and estates. So when upon death, with the estate tax, we add in the gifts that were paid, and we recalculate the tax, and then we subtract out the actual unified tax credit, or unified that amount. Okay? And that gives us our estate tax due. That gives us the estate tax due. So this is unified transfer on gifts, and then this is the tax credit, including the unified tax credit. I apologize, that was a little jumbled earlier, but just so you know, those are the two different things that we subtract out of there. That gives us the estate tax due. So the unified tax credit, again, it's unified in the sense both the estate and gift tax system. It allows donors and decedents to transfer specified amounts of wealth without being subject to gift and estate taxes. So remember, when it comes to gift taxes, there's an annual exclusion amount per year per each donee. But there's also this lifetime unified tax credit that's applied to both gift and estate tax. That's what we're talking about here, the lifetime amount. And that can change. That can be many millions of dollars, or it can be a lot less than that. It really depends. It's really changed over time. So you got to look at what is that unified tax credit in the year you're looking at an issue. And what I recommend doing is stopping the video right now and looking that up. What is the unified tax credit for the estate and gift tax right now in this year, in the year you're watching? Okay, very important. Valuation. So again, for estate and gift tax purposes, we use fair market value. And generally, it's the value of the property on the date of transfer for gifts or the date of death for the estate tax. Under certain conditions, though, the executor of an estate can elect an alternative valuation date, which is either 6 months after death or on a date of disposition if this occurs earlier. The alternative valuation date election is not available unless the estate must file a Form 706 and the election decreases the value of the gross estate and the estate tax liability. So the Form 706 is the form that we use for estate tax. The Form 709 is for gift tax, just so you know. So keep that in mind. And again, if you're going to do that, you're going to make the election for the alternative valuation date. So you're not going to do at the date of death. You're going to do another date. You got to make sure you make that election. So there's important property concepts involved. Because if we're looking at property, which is very much what gifts are, as well as what the estate is going to be when we're calculating the value of the estate. When property is transferred by gift or death, the form of ownership has a direct bearing on the transfer tax consequences. So there's undivided ownership, which can fall into various categories. Joint tenancy, tenancy by the entirety, tenancy in common, or community property. So this is basically saying if multiple people own the property, it can be under many different ways. And it makes a difference when it comes to estate and gift tax. Joint tenancy, tenancy by the entirety, tenancy in common, or community property. So not every state has community property. There's only a handful of, there's only, not a handful, there's more than a handful. There's only some states. The majority of states don't follow community property. But when it comes to joint tenancy, tenancy by entirety, and tenancy in common, you gotta look at the specific state of what the default rule is. And there's this thing where, oh, if it's titled, the property's titled and versus or, it makes a difference. I'm not going to go into the specifics of that. At this point, if you want to go in more detail about joint tenancy, tenancy by entirety, tenancy in common, please do a little bit more research of that, especially depending on what state you're in. Okay, very important. So you can go further with that. Partial interest. Interest in assets can be divided in terms of rights to income and principal. So if someone dies and they own a portion of an asset, they don't have to include the full amount. I mean, that could potentially be if you have a certain type of ownership, but if you just have a partial interest, then you're not going to have to, your normal rule is you're not going to have to include the full amount. So persons that are subject to the gift tax are citizens or residents of the U.S., and they're subject to all gifts of property wherever located, whether it's in the U.S. or not in the U.S., on non-resident aliens only if the gifted property was in the U.S. That's when non-resident aliens have to pay gift tax. And it's really important to understand that if a non-resident alien gets subject to the gift tax, that's very bad because the unified tax credit, the lifetime amount, is not as generous. It's not as generous for non-resident aliens. One other thing I want to mention, non-resident aliens can also be subject to estate tax upon death if the property is situated in the U.S. as well. So that's something also to consider. And again, with that unified tax credit being a lot less for non-resident aliens, even though it's very rare for it to occur for non-resident aliens to be subject to estate or gift tax, it does happen, and it's very, 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 it's going to hurt a lot of non-resident aliens that are subject to it. So what are the requirements for a gift? So first, the donor has to be competent to make the gift. So there have to be of sound mind, body, all that stuff you might have heard. And the donee is capable of receiving and possessing the property. There's donative intent of the donor, so there's actual intent to donate, to gift. There's actual or constructive delivery of property to the donee or donee's representative, and there's acceptance of the gift by the donee. Those are all important elements that must be met for a gift to actually have occurred. A transfer is not a gift if the transfer is incomplete. So what we're saying here is if there's any type of strings attached where there's not outright transfer of something, some type of string attached to it, like, oh, I can come on the property, that could be a severe limitation on whether something is a gift. You got to look at whether strings are attached. Does the donor still have certain rights? It's possible that the donee might have a gift of certain rights, but not all rights. But if a donor keeps a lot of the rights, a lot of the major rights, it's possible it might be viewed in a lot of under state law that it's not held to be a gift because there's so many rights that are kept. So an example is that funds that may be transferred to a trust. So if the terms of the trust allow the transfer to be revoked for any reason, the transfer is not considered a gift. That's just a normal rule under trust law and under most states. Now, federal gift tax does not apply to. So these are the transfers. These are excluded transfers. These are the things that if a gift, what we think of as a gift, if it's made to certain activities or certain groups, they're not going to be subject to the gift tax. These include transfers to political organizations, tuition payments made to an educational organization on another's behalf. That's an interesting one. So, and this doesn't just include colleges and universities. This also includes elementary, middle, high school as well. So if somebody pays for their child or for their grandchild's education, elementary, middle, high school, college, it's going to be viewed as not considered a gift. With respect to the gift tax, you don't have to worry about the annual exclusion amount. It doesn't come out of the lifetime amount. You don't have to worry about any of that stuff. Another thing is the amounts paid on another's behalf for medical care. Tuition and medical payments, so this is both for tuition and medical payments, must be paid directly to the provider. So this is important that's paid directly to the provider. You have to pay it directly to the hospital, have to pay it directly to the university or the school. The issue here is, what if you wrote a check out to the actual individual and said, okay, and you put in the line, oh, this is for tuition. Well, that doesn't cut it. You actually have to pay it. There's an issue here with dominion control. If it's paid directly to the university or the medical provider on the person's behalf, well, they don't have the ability to take that money and use it as they see fit. It has to be used for that purpose. So that's very important to understand. And another thing is satisfying an obligation of support. So that is not considered a gift under the law. So certain property settlements are not regarded as being for consideration and subject to the federal gift tax. That's very important to understand. Okay, this can be as a result of a marital separation or other results. As a special exception, transfers of property interests and settlement of their marital or property rights are deemed to be for adequate consideration. So remember, one of the first slides we talked about is that gifts are when it's less than adequate consideration. Well, it's viewed as, okay, you're transferring the right to receive the property. That's the consideration for this actual property. So it's viewed that marital dissolution, when property is transferred, that's not viewed as a gift. I mean, and you wouldn't view it as a gift, right? If you knew someone that was being divorced, they probably wouldn't say, oh, I'm gifting this to my ex-spouse. No, right? That's not what it is. So that's important to understand. It's not a gift. Disclaimers. Now, a donee can disclaim property. They don't have to take it. If that's the case, it's going to go to somebody else. It's possible that if a disclaimer is made, that the donor may not have to pay gift tax. So the federal gift tax can also be avoided in cases of a partial disclaimer of an undivided interest. So it is possible that if something transfers to a person, but then it's disclaimed, it might not be subject to the gift tax. That's very important to understand. So again, Form 709 is what we use for the gift tax. It must be filed whenever gifts for a calendar year exceed the annual exclusion per donor or per donee, or if a future interest is given. So if the annual exclusion amount for that donor is giving to that respective donee, if it goes over that amount, you have to file a 709. Even if you're going to use the lifetime amount, even if you can take out the remaining portion of the gift for that year that's above the annual exclusion amount, you can take that from the lifetime exclusion amount. So what I'm saying is, let's say for a year, the annual exclusion amount per donee is $10,000, and you give your grandchild $20,000 cash gift, and they can for their birthday. Well, that is a gift. Okay, there's no special exceptions. It's not for you're not paying it directly to university or hospital or whatnot like we saw, and it's to your grandchild. So that's a gift. So if it's $10,000, then generally speaking, the first $10,000 would be considered a annual exclusion. You don't have to pay gift tax on that. Now, some practitioners like to say don't use all $10,000 because or don't come close to that if you're trying to look at that number, because the person you might have to give other things later on. But here in this example, let's assume the grandparent only gave the $20,000. It's the only gift that the grandparent made to the grandchild during the year. It's $20,000. So the first $10,000 annual exclusion, and that's not subject to gift tax. But the next $10,000 has to be reported on the Form 709. And let's say that in this tax year, the lifetime gift or lifetime credit, the lifetime unified credit, or the lifetime applicable exclusion amount, which is also known. That's what it's also, they're referred to the same thing. One's in credit terms and one's in a like a deduction term. So the lifetime applicable exclusion amount, let's say that's $5 million. Well, that $10,000 can come out of the $5 million. So it goes down. And that's kept track over the years. Okay? And it's very interesting because different years, that applicable exclusion amount of the $5 million, which is reduced by a $10,000 in this example, that changes. So it really only becomes finalized on death. And that's why you have to recalculate everything. If you go back to the federal estate tax, remember, upon death, when we calculate the estate tax, we got to recalculate it because that tax credit, that unified tax credit, which again is the applicable exclusion amount, is the same idea, just in different terms. That's a function of the year you die. But we keep track of it, though, as we go. So if it changes, well, that's just how it works. Okay? Very important to understand. Very important idea. So let's go through an example. Let's go through an example of the taxable gift. So let's say that we have Jane and John, and they're a married couple, and they make the following transfers in the year. They have a $22,000 cash to their son Hal, $20,000 tuition for their daughter Beth, $60,000 to the American Diabetes Foundation, a qualified charity, $10,000 to the Young for Governor campaign, that's a politician, $200,000 to a revocable trust for the benefit of their two children, $30,000 for medical care and medical insurance for Jane's mother, $60,000 car to John's brother, subject to a liability of $30,000. Which of these transfers are treated as gifts for gift tax purposes, and what is the amount of the taxable gift before considering the annual exclusion amount? And the reason I'm just doing it before the annual exclusion amount is because when you're watching the video, it might be different than when your annual exclusion amount might be different than when I did this video, so I don't want to confuse you. So if we go back to the previous slide, we have 1, 2, 3, 4, 5, 6, 7 potential transfers that could be considered gifts. We have cash to the son, which I'll tell you right now, that's going to be for sure a gift, right? Before, again, we consider the annual exclusion amount. $20,000 tuition for daughter Beth, that could be considered education, but again, the question becomes, is it being paid to the university or the school? The $60,000 to the American Diabetes Foundation, that's a qualified charity, so that brings up an interesting point for charitable contribution, right? $10,000 to the Young for Governor campaign, that's for a politician. We saw that. $200,000 to a revocable trust for the benefit of their two children. Revocable being that the trust can be revoked at any time by Jane and John, who probably are they're on that trust, right? So they can revoke. $30,000 for medical care, and $60,000 car to John's brother. So several of these gifts are not included in the gross gifts. So again, the first amount to the son is going to be a gift, but the $20,000 tuition payment, the $30,000 medical care, and the $10,000 political contribution are not gifts by definition. That's assuming, again, that the tuition payment and the medical care are paid directly to the institution and the healthcare provider. The $200,000 transfer to a trust, since it's a revocable trust, is not a completed gift because it's revocable. The car transfer to John's brother is a 50% a sale for $30,000 because it's for the amount of the liability, and 50% is a gift. Okay? It's subject to a liability. If we go back, right, to that example, a $60,000 car is being transferred to John's brother, which is subject to a liability of $30,000. So John is going to take the car, but also take subject to the liability. So now John's brother is going to take the car and also have to take the liability. So John's brother is going to have to start paying off that liability. So really the net amount here, 60 minus 30 is 30. It's like the net equity in it. That's really what it is, $30,000. So that's going to be a $30,000 gift. So the portion of the liability, that portion, that $30,000 is not considered gift. So we get to subtract those portions away to calculate the gift. That's really what's going on here. Okay, so we go through the items, right? And the cash to the charity, that's added in. It's added in, but you notice that it gets subtracted out here as a deduction. So that's how we do this for both the estate and gift tax. We put in the gross estate or the amount, we put it in the gross estate or the amount of the gross gift, we put in the amount that was made. But we subtract it out at the end. So it gets subtracted away so it nets to 0. So it's not subject to gift tax, that amount. That's really how it works out. Cash to Hal, who's the son, is a gift at $22,000. The car to John's brother is the net equity of $30,000. Gives us total gross gifts of $112 minus the $60 for the charitable deduction of the cash to charity. This qualified organization, it has to be a qualified organization. Again, before considering the annual exclusion for each donee, it's going to be $52,000 is subject to gift tax. Then we apply the annual exclusion per donee. So if you look at this, right, let's say it's $10,000 this year per donee. You don't worry about the cash to charity because that all came out. But the cash to Hal, the $22,000 portion, 10 would be subject. So of the 22, only 12 is going to be subject to gift tax. Again, if it's 10,000, and the car to John's brother, which is 30,000, that's a separate donee. So 30,000 minus 10,000 would be 20,000. So it'd be 12,000. The portion of the 22,000 would be subject to gift to the son, and then 20,000 the car to John's brother. So 20 plus 12 is 32. So since there's 2 donees and we have the full amount of the 10,000 or more, we get to subtract away 20,000 for the 2 donees. Again, you don't get to use it for the charity because the charity was subtracted out fully. That was completely gone. So that's how we do the annual exclusion amount for the gifts. Again, make sure you know the amount for your year. That might be different than $10,000 when you're looking at it. Could be a lot different. I'm just using 10,000 as a round number. Okay, so that was the gift tax. Now let's go more into the estate tax. So the first thing we saw on that slide that dealt with the estate tax, we first have to calculate the gross estate. The gross estate includes all property owned by the decedent, subject to federal estate tax, valued at fair market value, again, unless you use alternative valuation, including the following: personal effects, jewelry, furniture, stocks, bonds, and other investments, the right to receive dividends or interest, and this can be an accrued amount upon up to death. And so like if you hold a bond, right, and it pays interest every, let's say, 6 months, and the person dies between payment periods, maybe 2 months in, well, there's accrued interest on that, and that has to be recorded as part of that bond. And the value of a business owned by the decedent upon death. So that's really the major things. There's obviously other things as well, but those are the big assets that go into the gross estate. The gross estate also includes the proportionate value of any asset owned by a decedent and any other person if both parties paid. So a decedent jointly owns, so an example is that if a decedent jointly owns a boat with his son, both parties paid 1/2 the initial purchase price, then only 1/2 of the value of the boat is included. So notice it's not 1/2 of the initial purchase price, it's 1/2 of the value upon death of the decedent goes into the gross estate. Asset values are determined at date of death, or again, the alternative valuation date as we mentioned earlier, which is usually 6 months, or if elected, a different date. So we do make adjustments for gifts within 3 years of death. This is for purposes of the estate tax. The idea here is that the gross estate includes any gift tax paid on gifts made within 3 years. So you have to include those. The idea is that these are like deathbed gifts. You know you're going to die soon. Oh, I'm going to start gifting a lot of stuff away to get it out of my estate. I'm going to pay gift tax on it, but maybe that can save you tax when with respect to having to pay the estate tax. So we call this the gross up procedure because it puts it back in. Now this is the gift tax paid, and as you see on the next slide, the actual amount of the assets. The gross estate also includes any property interest transferred. So that includes the value. So this is transfers of a retained life estate. So that's a life estate where you transfer property, but somebody has the ability for the rest of their life to have some right with the property. And then upon that, it transfers to another party. So they don't own the property in fee simple absolute. Transfers taking effect at death, revocable transfers, and proceeds of life insurance. All these are part of that. So it includes, that means it's not just, but it also includes these things. So, but any transfers of property within 3 years, the value of that property comes back into the gross estate. Okay? Even if it was made by gift. That's what it's saying. So both the gift tax paid, as we saw on the previous slide, and the actual amount of the gift in those years. And it's actually the value on the death that we actually put back in. A terminable interest limitation. So a terminable interest occurs when the interest in the property fails by passage of time or other event. This is something that we can go in great depth. I just want to mention it briefly, but if you need to look more into this, please do so. That's all I'm going to really mention. State death taxes. So some states like New York, New Jersey have an inheritance tax or estate or gift tax, and you're allowed to deduct. A federal estate tax deduction is allowed for state death taxes. So you're allowed to deduct the federal estate tax on those state death tax returns when calculating. That's an important concept to understand. So how do we compute the federal estate tax? So the post-1976 taxable gifts are added to the taxable estate to arrive at the tax base. We do this again because the unified credit amount or the applicable exclusion amount, again, they're the same idea. One's just put in credit amount and one's put in a deduction, a total amount like a deduction. Well, they change based on the year, and guess what happens? It's important to understand that we have to add back the gifts because if that amount changed, we have to recalculate that. That's why. So the unified credit amount depends on the year of the transfer. But again, that's for the gift tax. So on the gift tax return when you're taking out of that, but then upon death it could change as well. So that's why we have to recalculate and do it all over. Successive deaths of family members over a short span of time may generate a significant amount of estate tax liability. A credit for foreign death taxes is allowed because a double tax effect might arise when a U.S. citizen or U.S. resident owns real estate situated in a foreign country. So it's very similar to the foreign tax credit for the income tax system. There's a foreign death tax credit allowed on the estate tax as well. And then Form 706 is due 9 months after the decedent's death, and the IRS will extend the filing date for an estate. That's the filing date, not the payment date. And that's almost always automatic, just so you know. All right, so this is just a basic discussion of wealth transfer taxes. There's a lot more. You can have multiple classes on wealth transfer tax systems. So it's important to understand this is just basic. I hope you enjoyed this video, and please make sure to watch my other videos.